Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. You're listening to Destination Retirement. My name is Robert Kuhn of Kuhn Capital Partners, an SEC-registered investment advisory firm headquartered in Oak Brook. So we're right across from the mall. Hopefully, you know that by now, given the length of time that we've been on the radio, but a lot to get to this week. I think the job of an advisor is to educate, and I see and hear far too many investment advisors on the radio and just in general dismiss investments out of hand simply because they don't have a good working knowledge of what an investment is and what an investment is not, which in today's day and age, probably when you're going to them as the professional, it may come as a surprise that most investors, or many, at least it's our belief, many investment advisors, especially in the banknote strategy, have just a significant lack of understanding. And it is what it is. It's good for us. Unfortunately, sometimes advisors say things that they shouldn't, and we're going to talk about what that means this week. So 630-492-1912, 630-492-1912. If you'd like to have a conversation with us, as you know, everything we do is to try to educate. Everything on the radio show, whether it's talking about taxes or specific investments, it obviously is for informational purposes only because we don't know your situation. The purpose of the radio show is to give you an idea of kind of what we deal with as financial advisors and strategies that we find very appealing in certain markets. And if it makes any sense to you, or you want to learn more about that, then we'd love to have that conversation. So 630-492-1912. A lot going on. Markets, gosh, it's like Groundhog's Day when we're, hearing what's going on overseas in Iran. And as many of you know, if you've listened to the show in the past, we do have proprietary energy strategies. So we are obviously very focused on the energy space. And when you look at financial planning and you look at kind of wealth management, I think the most overlooked area is true tax reduction strategies that can greatly reduce your taxable income. And as you know, we're not licensed to provide tax advice again. And I think that's one of the reasons why many advisors shy away from strategies that provide significant tax benefits. And when we talk about tax benefits, we're not talking about matching gains with losses or tax loss harvesting, which is a tax strategy. I would say it's a very basic tax strategy, and I would hesitate to hold that out as being proactive tax investors or a firm that focuses on tax management, because that's such a basic strategy. But we can't provide tax advice, so take this for what it's worth. But when you look for strategies that can greatly reduce your taxable income, generally or oftentimes you're going to find investors turn to strategies in the oil and gas space, because in the oil and gas space, there's significant tax benefits. And you can go to ChatGPT and talk, just put in, provide me or educate me on the tax strategies of investing in oil and gas. And inside of our oil and gas strategy, we have a non-operated oil and gas fund, very diversified amongst operators, very diversified geographically, albeit in the Permian. It's a non-operated fund that is very unique in the advisory space, because when you look at investing in oil and gas, it truly is when you look at kind of the quote unquote institutional strategies, which there's a significant difference, in my opinion, between the institutional strategies and the kind of mom and pop strategies, which are the bulk of what you're going to find that you can invest in. It's dominated heavily by private equity, and so funds just don't need your money, and they'll go to an NCAP or they'll go to another private equity fund and get $100, $200, $300, $400 million commitment, and you just don't need individual investors' money. And what we determined was that there's a gap in that space. There's a real gap in what is being offered to individuals and what the institutional kind of strategies are. And so we set out to do everything we could to fill that gap, and we believe that we really have. And so when you look at the tax benefits, as you know, we target $80,000 per $100,000 of tax benefits for our investors, and that's against active income or passive income. And again, best practice, because we can't provide tax advice, is to always bring in your tax professional, and we can, if they're not well versed in oil and gas, they certainly should be, but we certainly can have conversations with our fund accountants and them. But the tax benefits have been significant, and so we are paying a lot of attention to the price of oil. And the higher the price goes, generally the better it is. But if you sold a business, if you sold a property, if you're a high wage earner, if you are had some sort of a liquidity event, let's have a conversation because, again, it's going to be new to you, generally speaking, but we want to help you think through it. And you can't rely upon investment advisors who have no experience in that space or limited experience in that space, unfortunately. So again, we want to help you think through that. So 630-492-1912, 630-492-1912. If you've listened to the radio show, you know we're a proponent of structured notes, bank notes, Phoenix Auto callable notes. Call them what you want. We call them bank notes for short. We had a situation that we were listening to a station recently, had actually a client call in and tell us about it. And it's very unfortunate. It's very unfortunate that advisors who have such a lack of knowledge make statements that really just make us shake our heads. And most advisors, unfortunately, dismiss structured notes for one simple reason. They truly don't understand them. If you've asked the average advisor to explain how a Phoenix Auto callable note works, including its coupon barrier, its principal barrier, its call schedule, its underlying asset, its maturity risk, in my opinion, 95 to 97% cannot do it accurately. Yet many of those same advisors will confidently tell clients that structured notes are not a real investment or too complicated or should be avoided altogether. And that's so shocking to me. And candidly, that's awesome for us because the amount of seven-figure investors that have interest in them, we love it. So advisors, if you're listening to the show, keep showing and keep proving that you're not objective and you don't have a good working knowledge of a very, very basic strategy. Is there some components to it that you need to understand? Of course, but it generally takes 30 minutes, for you to understand what a banknote is. And it's a problem with the industry. It's a problem with the industry that advisors fail to educate, investors. And sure, it takes a lot of work. Sure, it takes some education, and it takes, some time for an individual who's not readily, working in this industry to understand something new. Yeah, it may take a week, 2, 3, or 4, or 5, or a month or two, but so what? Isn't that the job of an advisor? And so structured notes are issued by many of the world's largest and most respected financial institutions. And we have one that we do tier 1 and tier 2, which, are index based. And so they track indexes, and generally they're paying 12 to 13% with 30% downside of those indexes. And it's actually a prospectus item, which is even better. It's a prospectus item. And so we did, we call it the Mini Mag 7. And I don't know if that name actually represents, what it is, because it's 3 of the Mag 7. So we call it the Mini Mag 7. And so we did, we started to incorporate, those individual stock notes as well. And the last one we did, which was issued by TD Bank. And so guess what? The prospectus is on our website. And so you can actually read it. It's a defined strategy where it shows you exactly what is going to happen based upon certain outcomes. And this one was Amazon, Google, and Meta. 30% downside on the coupon payment. This one priced at 27.60. That is significant, 27.60 annually, and the observation was on the 23rd, will be on the 23rd of every single month. And so as long as none of those 3 stocks are down 30% or more, your monthly coupon payment was actually, is 2.3%. Now, if one of those stocks goes down 30%, which certainly could happen. Okay. I mean, come on. I mean, it's not, these are, Amazon, great company in our opinion, Google, great company in our opinion, Meta, great company in our opinion. But could it go down 30%? Absolutely, it could go down 30%. And if it does go down 30% on the 23rd of that month from issue, then you miss your coupon payment for that month. So I strongly encourage investment advisors that make ridiculous, outlandish statements because of their lack of knowledge to really reconsider what benefits you're bringing to the investing public when you don't have an understanding of what it is. And again, it's my belief. I have so many close friends in this industry. I'll just pick 10 of them, and probably one could articulate what these strategies are and make me understand quickly that they know what they're talking about. Now, 10 of 10 could probably make you understand it, but most are not going to, unfortunately, be able to articulate it. And the question is why? Because we have clients that call us and say, we've talked with other advisors that say it's a bad investment, but yet we keep getting paid every single month. And it's comical to them that advisors have such a lack of knowledge. And when you look at the industry, it's so pervasive because the industry has become 60-40, 70-30, equities and bonds, and set it and forget it, and let the advisor go out and manage, try to raise more money so their revenue can go up. And it's phenomenal for us. I don't know what we've done this year in new issuance, 60, 70 million. Would be my guess. Hopefully we'll end the year over 100. We'd like to do $1 billion. And it's just, what most individuals will say when they hear and they understand what the investment is, why doesn't everybody do it? And they're just amazed that most advisors just don't even share, these strategies with them. And that's what our job is to do. Our job is to educate. We're going to keep doing it. And for those advisors that want to make just false, outlandish statements, we love the fact that you show your ignorance. So 630-492-1912, 630-492-1912. More after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC-registered investment advisory firm. Thank you for listening. Thank you for those that reach out. Our job is to raise the financial IQ of the individual investor. If you want to have a conversation about the banknote strategy, the banknotes are still, the index notes are still, I think we did a Goldman note last week, and believe it priced over 12. But we encourage you to look at it, because when you have a defined outcome strategy, it gives you the parameters, it gives you the return profile before you invest. And so you can determine, if it's something that you have an interest in. So 630-492-1912. Financial planning, still running a significant amount of financial plans. We love it. Financial plans, as I tell everybody that when we first meet, it's generally not, we don't see a financial plan as something, or a tool rather, to determine whether you can, whether you're going to outlive your income. It certainly does that. It gives you the probability analysis. It gives you the Monte Carlo analysis. But most people intuitively know, how long their money's going to last. But that being said, it certainly is part of the plan. It's certainly something that we discussed, no doubt about it. My belief is the greatest strength of the plan is really on the tax side. How can you reduce your taxable income? How can you reduce your RMD tax that ultimately is going to be due? And we have the software to do that. It'll give you a look through on your tax life like you probably haven't seen. And the software is very cost prohibitive for individuals, and many big firms don't let their advisors use it, which is shocking to me, because we have to be very clear that we can't provide tax advice, but that doesn't mean that we can't educate when it comes to taxes. And especially when you look at, obviously Bison 2, the energy strategy, again, it's very important to know that, when you look at what that provides, it provides you access to a real assets, a very diversified strategy by the biggest and many of the biggest and best operators in the Permian Basin, which clearly is one of the best oil fields in the world, certainly here in the United States. But those tax strategies are significant, and we target an $80,000 for every $100,000 tax benefit that can be reduced against active or passive income. But again, it can't provide tax advice, so it's always best practice to bring in your tax professional. But it's a great strategy. And so when you look, I think there's a lot of great strategies when it comes to tax management. I don't want to just say that's the only strategy. But when you look at the financial plan, which is where I was going with this initial thought, was if you have a seven-figure IRA or a multi-seven-figure IRA, the RMDs are going to, if you haven't looked at what the tax implications are going to be from the RMDs, they can be significant, very significant. And there are so many individuals who have significant, portfolios that have been told that they can't do Roth conversions, and they can't because it just doesn't make sense. And that may be the case. But if you have a strategy that can potentially, and everybody's tax situation is different. That's why we always say, you have to loop in your tax professional, but can reduce or eliminate based upon your investment in strategies that provide, tax benefits. It's something to think about. And it may take 10 years. It may take 8 years. It may take 5 years to implement that strategy. But if you have a multi-seven-figure IRA and somebody or your advisor hasn't shown you what those RMDs are going to be, and in many instances, we've seen $300,000, $400,000 of taxable income when you have to start to take them RMDs, and it just takes some planning. So 630-492-1912, 630-492-1912. But to go back to that statistic that I mentioned, I don't know if the Microsoft, whether it was this segment or last segment, to where it took you 14 years to get back to even if you invested in 2000, we're cherry picking that date. I mean, 100% we're cherry picking that start date. Okay. That just clearly is a date that was at the market highs. And if you move that out 6 months or 12 months, the statistic may be totally different. So we want to be very clear in that, but we're using that statistic to show you that if you invest at market highs, it can take you a significant period of time to get back to even. And we could be at a market high. I don't know. You don't know. Your advisor doesn't know. Nobody knows. But the reality is, when you look at where the markets are today, unless it's different this time, and I always say those are the four most expensive words of investing, is it's different this time. If you invest and the markets go down, it may take you a substantial or significant period of time to get back to even. And so many of you know that we have our Bison Alpha proprietary hedge fund strategy. That is a strategy that we run. It's a strategy that we are very proud of. And we look at it, and right now it's a very tech heavy-weighted strategy of many of the names that you would recognize, and a lot of people want exposure to those. But if you invest on your own, and the markets go down, unless you have significant cash held back, or you want to sell other investments to dollar cost average down, you're going to just have to sit and wait. And one of the beauties of investing in a fund is, as long as we own those names, of course, because we can sell those names if we choose to. But right now we don't believe that we're going to do that. But of course that could change. But when you have the ability to have continuous capital come into the fund, and that's another caveat. I mean, money has to come into the fund to make new purchases, right? But when you own a fund and that fund owns, let's say, 7 stocks, and those stocks go down, we have the ability, as money comes in, to dollar cost average into those stocks and lower the cost basis. And so if you want a strategy that is what we believe to be owns the best technology stocks out there, then the fund is something that you should consider. And I believe it's a lot less stressful when it's in a fund that can still add additional capital when the prices are lower. And so we were sitting, around and we were really, brainstorming this with clients, in that why would they buy, our handful of technology names versus just going out and doing it on their own? Well, obviously we do a lot of research, and we believe that we own the best, tech names out there that are going to, provide the most growth over, the next 3 to 5 to 7 years. But who's to say we're right? I mean, you could, that's, just a personal opinion. But the main benefit is, if you're in a volatile asset class, which I think, tech, I think the Mag 7, I think it is a very volatile asset class. I mean, look at what NVIDIA did in 2022. I don't have the numbers exactly right in front of me, but I think it was down 40 to 50%. Well, if you'd bought it in 21, you're just sitting and taking it, right? Unless you have capital to put into work and the dollar cost average in, and then to, or sell other names to buy losers, but that's very hard for individuals to do. The benefit of the fund is that the fund can do that, and you own a piece of the fund, and the fund owns the individual stocks. And so during 2022, assuming now the fund didn't exist in 2022, but had it existed, and had we still believed in the name and we still raised capital, we're buying it at lower prices. And when there's the subsequent rebound, if there is ever a rebound of an individual stock, I mean, obviously the names that we own, we're very, very confident that there will be. It's just a benefit to you. And so there's so many things that, again, the job of an advisor is to educate you on the pros, the cons, the risks, the rewards, and really help you think through why you make allocations to certain asset classes. And advisors, unfortunately, it's my belief, are just not doing it. They get their fee, they get their 1%, 1.5%, 2%, whatever they charge. They let the market manage the risk. The markets seem to never go down. They look like geniuses until the markets do go down. And they're more concerned about, raising the firm's AUM, assets under management, because their revenue goes up. So, we'd love to share with you, the Bison Alpha strategy as well, and why we think that could be a 5%, 3%, 10%, 20% holding of a portfolio if you want a structured way to invest in technology. So 630-492-1912, 630-492-1912. We're going to talk about inflation and annuities after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent SEC registered investment advisory firm headquartered in Oak Brook, right across from the mall. So if you have not come to see us, you're always welcome. Love to have people stop in. A lot of people do, actually. It's great. So I really am pleased to see that. So 630-492-1912, 630-492-1912. If you just joined us, banknotes are still pricing relatively strong. Our index notes are, I think we did a Goldman note last couple of weeks that was in the 12% range, so that's great. And the individual stock notes, as you know, the Minimag 7, which is the three notes that we use, Meta, Amazon, and Google. That last one priced at 27.6. Actually, TD Bank did that one, so that was a very significant pricing, actually. 22% was the one before that, so it jumped a lot. So very, very pleased with that. So have any questions on that? If you'd like to learn more about that, the banknote 630-492-1912. Spent some time talking about the Bison Alpha hedge fund strategy, $2.1 million net worth or $1 million with the firm. That net worth is excluding your primary residence. So if you meet that criteria and you want to see if that fund could benefit you, especially really, again, given the volatility, we love it, especially in the tech space. I think it's a pretty significant benefit for individuals and something they should consider. Please obviously reach out. Bison 2, our energy strategy, very pleased with where we're at there. That fund is closing at the end of the year. So 12/31 at the latest. I think we have 19 million left to raise. So tax benefits there are very significant. I am not a tax professional, so it's always best practice to talk with your tax advisor. Certainly loop them in the conversations, but we always target $80,000 per $100,000 invested. That could be used to offset active or passive income. Just do some research. Go to your favorite AI agent and type in tax benefits for oil and gas investing and read about the three. They are the IDCs, TDCs, and the depletion allowance. And so you'll get some really good information there. It's again, if you're just joining us, a very diversified strategy. So 5-year target at exit. This fund could actually... I think we're in month 17 or 18. I'd be surprised if it went the full 5 years, but I guess you never know. But certainly oil prices, given where we acquired and where we think they're heading, this could be really good timing. So if you have any questions or you want to learn more about that, especially if you're a high wage earner, you want to talk about Roth conversions, you had a liquidity event of some form or fashion, or you just want to see, how private oil and gas investing can reduce your taxable income and increase your diversification, certainly give us a call, 630-492-1912. Inflation is obviously front and center for a lot of individuals. Concentration of the market is front and center for a lot of individuals. And when you look at where you're at in the market and you look at kind of bubbles, we know that we're going to have lots of bubbles, obviously, over time. You always do, which isn't a bad thing. And that's one of the reasons I love the Bison Alpha hedge fund strategy is just the fact that we can continue adding capital where individuals, if you're going to put money in a stock, unless you have a dollar cost averaging strategy, if it goes down, you're just at the mercy of that point in time of where you bought it. And so I think the benefit of the fund has many benefits in our opinion, but that certainly is one of them. But when you look at where bubbles tend to peak, it's generally at about a 40% concentration level. And the current AI bubble, if it's a bubble, maybe it's not a bubble, I don't know. But it's currently at around 41%. So if you look at the Nifty 50 in the 70s, if you look at Japan in the 80s, tech in the 2000s, and then potentially AI in the 2020s, we're getting there, right? And it's, again, the job of advisors when we talk about portfolio construction and we talk about oversimplification, right? And when we meet with individuals, if you have 100%, I mean, if you can, my belief, again, everything is just my opinion, my belief, is if you can articulate every single investment strategy that you have in your portfolio, you probably have a very, very basic portfolio that is nothing more than stocks and bonds. And when the market's going up, that's probably okay, even though when you look at the U.S. bond market, statistics show us we've now been in a drawdown for 6 years, which is really by far the longest in history. And I see so many people that are still tying money up in the bond market for, if you just look at AGG, I don't know what the exact yield is, but I think the 10-year annualized return has been somewhere in the 2% range. That's just a challenge. And when we look at inflation and we look at, what is going on in the world today, very few people would say it's cheaper to live today than when it was, 3 to 5 years ago. And that is, haven't talked about it a lot lately, but that's my big concern with the lifetime income annuities, is that the growth on paper, it's probably there because they are able to illustrate hypothetical back-tested performance. But when you compare the real performance, in many instances, it is night and day. And I see so many people that are being sold the lifetime income annuities and telling them to defer, the income for, 5 to 7 to 10 years, and then, take a fixed payment of some sort for the rest of your life. And as you know, I haven't talked about it a whole lot in the last few episodes, but you're just taking your own money out of that account until the account goes to zero. Once the account goes to zero, then you are into the insurance company's pockets. And I just would love to know the statistical analysis of how many accounts actually go to zero. I think that should be shown on these illustrations. If they're able to show hypothetical back-tested data, which shows ridiculous returns, I would think that, individuals should be shown that. But a lot of times that 7, 8, 9, 10% annuity commission, blinds, many investors. And that's not to say that we haven't done lifetime income annuities, because we have. In some situations, the clients, are adamant about it, or it just fit. But to make a business on that, I see far too many people that, 80 to 90% of their business are those. And then you have to, those strategies, then you really have to question the objectivity of the investment. And I would compare those to the banknotes. Compare them to, our index-based ones, our S&P, Russell, and KRE. And, I think, like I mentioned, the last one we did was Goldman Sachs, and it was 12%, I believe. Compare that, and that's 12%, assuming those indexes don't go down 30%, which you have to understand that. Each month from inception, they're going to look at that investment for the first 6 months, and you have a 30% buffer before you don't get, that coupon payment. So, compare that, do the math on that versus one of those lifetime income annuities, and I bet you'll be shocked of which is going to produce, more growth and also more future income. So, when we talk about Bison Alpha and you talk about kind of the hedge fund strategy and why we love tech so much, when you look at, average earnings and average analyst estimates, and you look at, the Mag 7 and their growth projections over the next 5 years, again, these are just projections. And so it doesn't mean that it's, sometimes people will say projections are just voodoo. Well, the average of all analysts, you look at Tesla and, almost 500% profit growth in the next 5 years, NVIDIA 340, Amazon 173, Alphabet 170, Microsoft 119, Meta 89, Apple 54%. And again, that's based upon average analyst estimates. That's one of the reasons that we love the hedge fund strategy, is that tech is very volatile. But when you have a strategy that, assuming that we still own those names. I mean, that's the big caveat, right? And then you have, constant capital into the fund, and that's the second big caveat, of course. I don't know what's going to happen tomorrow. We believe that, there'll be a steady flow of constant capital, but, as long as those two assumptions are met, and if there is volatility and we're able to, buy at lower prices, when you ultimately, get that rebound, if there is a rebound, just think about the difference of returns in that, strategy versus you just holding those names, independent. And that's one of the reasons we did the Minimag 7 note in Amazon, Meta, and Google, was because a lot of people want exposure to those names. And like I said, the last one, TD Bank issued 27.6%. And that is crazy, actually, but it is. You can look at the prospectus. Just got the right, the right volatility at the right time and price that note in. And, again, you have a 30% buffer before you don't get your monthly coupon payment of 2.3 or 2.4 or whatever that was. But you have to understand that, those stocks could go down 30%. And then you could miss, a payment or two or three or four or five, depending upon, when the market, ultimately, rebounds and comes back. But with that being said, I always encourage anybody to read the prospectus. We keep the prospectuses on the website. So you can go to kuhncp.com, kuhncp.com, and there's probably a banknotes or something like that tab. I haven't been there in a while, and you can look at it. So more after the break, 630-492-1912, 630-492-1912.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, registered independent investment advisory firm, headquartered in Oak Brook. That doesn't mean that if you're catching this on the podcast that we can't work with you. We have a relatively diverse client base. I think we're in close to 24 or right around 24 states right now. And I would really strongly encourage you to look at where the markets ultimately are going to go 3, 5, 7, 10 years in the future at current PE ratios. A case can be made that we're going to, see significantly lower growth. And so I encourage you now to really double down and make sure your portfolio could handle a flat to sideways market. Or a meaningful correction. And, those are things that I think can be done. They can be done objectively. They can be done through software. They can be done through just kind of stress testing portfolios. And that is my suggestion. So if we can help you out with that, 630-492-1912, 630-492-1912. Set some time up. Our first meetings generally are just kind of laid back. Again, we want to help you think, right? And that's not to say that you can't think on your own, because of course you can think on your own, but you have a group of advisors here that my belief is we think significantly different than the average advisory group that's just going to put you in, equities and fixed income and charge a fee and call it a day. That'd be the easiest thing for us to do. And we talk a lot about banknotes, obviously, on the radio. And when you do the volume that we do, a significant amount of accounts, and that's just a lot of work. It's a lot of labor, and it's very labor intensive. And that is one of the reasons I believe most advisors simply don't do it, is because of the amount of work that is required to educate, number one, because when you're introducing something new, it's going to take you and the listener some time to understand. Well, you're going to go through, well, it's too good to be true. Well, look at, how in the world can you do a note that's, priced at 27.6%? How is that even possible, right? how can I get an annualized 27.6% with, monthly coupon payments of whatever that breaks down to, 2.4, 2.5, as long as those, those stocks don't go down 30%. Most people don't even think that's possible. And so many listeners are going to go through it's too good to be true. Well, 27 was crazy. I mean, I'll be honest with you. That surprised me. That same note a month or so before priced only at 22%, which is still, my goodness, still very, very good. But you do have individual stock volatility. I mean, come on, we're not using names that don't move here. That is what is driving the premium, right? But if you look more at our index-based note, the KRE, the S&P, and the Russell, the Goldman note, I think, priced at 12. And then we also do the Dow, Russell, and the S&P, which is, we call it our most conservative note. I think that priced at 10, somewhere in that neighborhood. I think it was above 10%. But when you combined all three, compare that to like a fixed income bucket. If you have an advisor that just dismisses any investment just out of hand, chances are they don't know what they're talking about, and they don't want to get into, the fact that, they just don't know. and I see it all the time. The lack of knowledge in the structured note space is shocking. And, don't believe me, fight Goldman. Don't believe me, fight JP Morgan, fight TD Bank, fight BNP, fight BMO. Go read their prospectus. Do you think they're lying? And when you have advisors that just make outlandish statements, it shows their ignorance, and it shows that they may not have, the investor's best interest at heart, because that's a basic strategy. 20 years ago, maybe, no, it's 2027 now. So 27 years ago, or 26 years ago, maybe it was cutting edge, but it's just not a mass marketed strategy. And we love it. So it's our competitive advantage, and we're sticking to it. But again, everything on the radio, I don't know you, you don't know us yet. I don't know your situation. Could be the best investment, could be the worst investment. I don't know if you need tax benefits, in Bison 2. But here's what we do know. Price increases over the last 7 years have been significant. And when you look at inflation and you look at what that does to your purchasing power, you have to have growth. And to me, that should just be readily known, because when you have, used cars, and this is the cumulative price increase in the U.S. over the last 7 years. Now I didn't do the work, so it's, from a source that we believe to be very reliable. Very, very big, group. But new cars, 22%, used cars, 29%, groceries, 33%, shelter, 35%, health insurance, 38%, restaurants, 39%, goes all the way up to home prices, 60%. So you think about your portfolio, and you think about, what if we have a significant period of time where we have low growth, or we have below trend growth? What does that do to your goals and your objectives? That is something that we're going to start spending a tremendous amount of time talking about. And I know we talked about we called it the Tax Summit. I don't know if that's a good name for it, but we are going to host pretty regularly now. We're in the process of planning this right now. And so if you have any interest in getting on the list, we don't want to do these big cattle call, dinners where, you get a free steak that's $100 and you come to hear some pitch. We've been there, done that, tried that. It just never worked out for us. Maybe because we just are more focused on education rather than, selling and trying to drive something in to an investor for our benefit or our motives. But we are going to start to host what we're going to call small workshops. And it may be at a restaurant, but it's somebody that has expressed interest. It's somebody that has expressed, an interest in the hedge fund strategy and why, and wants to do a deeper dive, or has expressed an interest in, Bison 2 in the private energy space, and has expressed an interest in learning more about the tax reduction benefits, the diversification benefits. We're going to start to host, more of those, hopefully on a monthly basis, because, the banknotes, for example, were, obviously hitting a nerve with many, many advisors because of just things that are said and that get back to us, which is just shocking to me, given that it's a prospectus item, that you can read the prospectus. You can go to kuhncp.com and read the prospectus. Now, it's a past prospectus, right? But if we're doing the same terms, it might be a different bank and it might be a little bit different language, but you can educate yourself. And I hear it, from some of our best clients, some of our most affluent clients, that, most advisors would love to have them as clients, and they're prospected constantly. And they share, the banknote story, and they continuously hear, oh, that's not true. Oh, that can't be the case. Oh, that's a bad investment. And it just shows the lack of education and true objectivity in the space. Now, the advisor may believe that, and there's a difference between saying that's a bad investment or I believe that's a bad investment. And, so we're actually, probably we'll start to have our workshop series on the banknotes as well, just because they're so popular. And so I don't know what the name of it's going to be. Maybe we'll just call it the workshop series, and we'll have a calendar that you can get access to. Maybe that's what we'll do. We'll call it the workshop series, and we'll have a calendar as we schedule the dates that you can just readily click on, and you can see where it's going to be hosted, and you can see what the topic's going to be. And if you want to attend, you just let us know. So 630-492-1912, 630-492-1912, workshop series. So we just in 3 minutes had our name, workshop series. So that's what it's going to be. And we are going to really start to implement that. Probably, let's see here, we are beginning of August. So we'll start it in September. And again, I don't know if it's going to be at a library, if they'll be at a restaurant, if it'll be at our office, if it'll be at a community center. We just want people who want to, come for the education and, be there for the right reasons, be there to learn and see if it, makes sense, ultimately, potentially for you, obviously. But so we'll get that set up. And we'll get that hopefully by the next radio show next week, that I'll be able to announce that it's ready to go. But we'll do that. Locations, probably we try to stay centrally located. Obviously, that's why we moved from Naperville to Oak Brook. We believe we're more centrally located from really all the suburbs, except maybe far north. But we'll so you may see TBD on location, but as soon as we can get those, at least you can mark the date and you can in the topic in. And if you would like to attend, then we certainly would love to have you. So with that being said, hopefully you got something out of this week. Markets are crazy. Seems like every other day, the what's going on in Iran is changing. Just is absolutely crazy what's going on in this world. But our job is to bring you ideas. Our job is to help you think. Our job is to provide solutions and options that you may not have readily heard about. And if we can help you in any way, certainly please make sure to give us a call, 630-492-1912, 630-492-1912. Have a great week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.